Cho Keng-Yut finds out how investors can avoid the traps of small-cap investing.
Whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. Warren Buffett said this in a 2008 annual shareholder letter. And for market watcher Terence Wong, the best place to hunt for value is in the small cap space.
Many of them are ignored by the market. They are under-researched. Very, very exciting growth prospects, trading at low valuations. So if some of the investors go in early, these could turn out to be very, very good investments for them with fantastic returns.
Mr. Wong's Azure All-Star Fund, a special situations fund that invests in privatization plays, turnaround plays and ignored, unloved stocks in the small and mid-cap space, has seen its net asset value rise 11% since inception 7 months ago. The fund has also hit its target of 100 million Sing dollars of assets under management. So what exactly are small caps? The Singapore Exchange into a value trap. A value trap is a stock that has been trading at cheap levels for an extended period of time.
We want to look at some financials as well, and we want to look at potentially good return on equity or growing return on equity over the last 3 years or so. We look at operating profit margins. You want to see good profits, and potentially also you want to extend that lens into the balance sheet and also see that the company is operating with low debt or not too high debt.
As yours, Mr. Wong agrees that investors should look for companies that are properly geared.
It's not to say a company that has no debts are automatically good.
So would companies with no debt be sort of a red flag for investors?
Yeah, take into consideration our information technology companies. Some of our hardware companies are sitting on a lot of cash and basically very well poised to service in the upcoming digital disruption type of cycle that we're seeing right now. So companies can basically be producing good money, sitting on good cash, and therefore have less need to take on debt.
Therefore, to make their stock picking exercise more complete, investors could look at another balance sheet item, the company's cash position. Micromechanics has no debts and a healthy cash position. The company has been able to use its excess cash to expand during economic down cycles.
We make use of this downturn. We have a very good bargain with those service providers and also the machine makers. I think it helped us to turn around after the financial crisis. And that's the reason why you see our revenue really jump up.
SGX Stock Facts allow investors to input their search criteria to pick small caps. The website has search criteria for market data, valuation and financials. From there, it generates a list of companies that fits investors' criteria. Aside from valuations and financials, management is key when investors look for value in the small cap space.
These guys are the ones that the visionaries of the companies, particularly companies that have the founder who is at the same time running the company. They know these companies inside out. They are the ones that would actually chart the growth plans going forward.
And before leaping into small caps, investors may want to be mindful about the challenges of small cap investing. There remains a general lack of analyst coverage of these counters. Micromechanics has put in place safeguards to protect investors' interest.
For example, you look at the board. We have 6 members, 3 independent directors and 3 executive directors. And we have no relationship at all. We also have a certain amount of a share. So in other words, we and the stakeholder are in the same boat. And also another thing is for compensation rights, we kept 15% of the profit before tax to distribute to our staff, including the executive director.
Small caps are also more illiquid and prone to periods of volatility.
very often people will try to build up a position. And then when there's a spike, some people notice the company, there's a spike, and volume increases tremendously. If you don't get out at a point in time, you could get trapped. Because after a while, the liquidity dies off, and then you realize that you are stuck in the stock even though it is attractive.